$950 billion. That's how much commercial real estate debt is maturing in 2025. $950 billion that needs to be refinanced or repaid. And here's the problem. Most of it can't be. Office buildings sit at 20.7% vacancy, the highest in history. Delinquency rates on office loans just hit 11.7%. That's higher than the 2008 financial crisis peak of 10.7%. Property values are down 18% from their highs, but the debt hasn't changed. Owners borrowed at 3% interest rates in 2020 and 2021. Now they need to refinance at 6%. The math doesn't work. The buildings aren't worth what's owed on them. 30% of office loans are underwater, and $950 billion is coming due this year alone. Through 2028, it's $2.3 trillion. This isn't a prediction. This is already happening. In August 2025, 1211 Avenue of the Americas, a 2 million square foot office tower in Midtown Manhattan defaulted on a $1.04 billion mortgage. That's not a distressed building in a failing market. That's Midtown Manhattan. And the delinquencies are accelerating. We've seen this pattern before, twice. In the 1980s, the savings and loan crisis destroyed over 1,000 institutions and cost taxpayers $160 billion. In 2008, the financial crisis nearly collapsed the entire banking system. Both times, commercial real estate was the trigger. Both times, everyone said it couldn't happen, and the people who recognized the pattern made fortunes. Right now, in 2025, the math says we're next. Before we show you how this ends, you need to understand how bad it already is. Because the commercial real estate crisis isn't theoretical. It's not coming. It's here. Office vacancy hit 20.7% in the second quarter of 2025. That's the highest on record ever. Not just since COVID, the highest vacancy rate in the history of tracking this data. And it's not recovering. It's getting worse. Delinquency rates tell the same story. Office loans packaged into commercial mortgage-backed securities, CMBS, are now delinquent at 11.7%. That surpassed the 2008 peak. The financial crisis that nearly destroyed the global economy had office delinquencies of 10.7% at the worst point. We're past that now. Multifamily isn't far behind. Apartment building loans are delinquent at 6.9%, the highest since 2015. Overall, commercial real estate delinquencies are at 6.57%, up from 4.51% just 2 years ago. This is accelerating, and the losses are massive. Commercial property values are down 18% from their peak. That's an average. Office buildings in secondary markets are down 30 to 40%. Class B and Class C buildings, older properties without high-end amenities, are down even more. Some are worth half what they were in 2021. But here's the critical point. The debt didn't fall. If you borrowed $10 million against a building in 2021, you still owe $10 million. But now the building is worth $7 million or $6 million. You're underwater. And when your loan matures, the bank isn't going to refinance $10 million on a building worth $6 million. You either come up with $4 million in cash to pay down the loan, or you default. Most owners don't have $4 million in cash, so they default. And here's where the crisis becomes systemic. Banks hold $6 trillion in commercial real estate debt. 51% of all CRE debt is on bank balance sheets. And it's not the big banks. It's regional banks, community banks, institutions where commercial real estate loans often exceed their total risk-based capital. When those loans start defaulting, the banks don't have enough capital to absorb the losses. They fail. We know this because we've seen it before. In the 1980s, the savings and loan crisis. Let me show you the pattern, because it's identical. In June 1979, the Federal Reserve started raising interest rates to fight inflation. The federal funds rate went from 9% to 15.2% by March 1980, then higher. By 1981, the Fed funds rate hit 20%, the highest in American history. Paul Volcker, the Fed chairman, was crushing inflation. But he was also crushing the savings and loan industry. Here's why. Savings and loans were institutions that took deposits and made long-term home mortgages. Those loans were locked in. But when Volcker raised rates, they had to pay depositors higher interest to keep them from withdrawing their money. By 1981, they were paying 12, 13, 14% on deposits. But they were only earning 6 or 7% on their mortgages. They were bleeding money, paying out more than they were taking in. By 1982, the S&L industry collectively had a negative net worth of $100 billion. 1/3 of all savings and loans were insolvent, technically bankrupt. But regulators didn't have the money to close them. The Federal Savings and Loan Insurance Corporation, the Deposit Insurance Fund, had only $6 billion. It would have cost $25 billion just to pay off depositors of the failed institutions. So regulators did what regulators always do when they don't have the money. They let the insolvent institutions stay open. They called it forbearance. The industry called them zombies, zombie S&L. Technically dead, but still operating. And then Congress made it worse. In 1982, they passed the Garn-St. Germain Act. The idea was to help S&L diversify, to give them new ways to make money. The law allowed S&L to make commercial real estate loans up to 40% of their assets. Previously, they could only do residential mortgages. Now they could lend on office buildings, shopping malls, apartment complexes, and they could take equity stakes. They could be investors, not just lenders. And there was more. The law eliminated loan-to-value limits. Before, S&Ls could only lend 75% of a property's appraised value. After 1982, they could lend 100%. No equity required from the borrower. And in 1981, Congress had passed tax reform that gave massive incentives for real estate investment, accelerated depreciation, passive loss deductions. Real estate became a tax shelter. The combination was toxic. The savings and loans, many of them insolvent and desperate, started pouring money into commercial real estate. Developers who couldn't get loans from traditional banks went to S&L, and they said yes. Office towers, shopping centers, condo developments, anything. Loans were made with no equity down, inflated appraisals, and optimistic projections. It was a boom. Commercial real estate construction exploded, especially in the Southwest. Texas, Arizona, Colorado. Oil-rich states building like there was no tomorrow. But there was a tomorrow, and it was brutal. In 1986, oil prices collapsed. Texas, which had been booming, went into recession. Office vacancy in Dallas, Houston, and Austin went over 30%. Real estate values crashed. The buildings that S&L had financed at inflated appraisals were suddenly worth half what was borrowed against them. Loans defaulted. S&L took massive losses, and the tax law changed. The Tax Reform Act of 1986 tightened depreciation rules and eliminated many of the tax shelters. Real estate that had been built for tax benefits suddenly had no reason to exist. Values fell further. By 1988, savings and loans were failing at record rates. In Texas alone, 40% of all S&L failures nationwide occurred in 1988. The Federal Home Loan Bank Board, the regulator, couldn't keep up. In one case in Texas, they decided it was cheaper to burn unfinished condos rather than try to sell them, literally burn them. The FSLIC was insolvent. In 1989, Congress passed the Financial Institutions Reform, Recovery, and Enforcement Act, FARIA. It shut down the FSLIC and created the Resolution Trust Corporation, the RTC. The RTC's job was to take over failed savings and loans, seize their assets, and sell everything. Between 1989 and 1995, 1,043 S&L failed. The RTC liquidated $394 billion in assets. Taxpayers paid $160 billion to cover depositors. Economists estimate the total cost of the crisis at $600 billion. And here's the lesson that everyone forgets. The crisis was entirely predictable. The math said it was coming. Interest rate shock plus commercial real estate overbuilding plus deregulation equals systemic failure. The people in charge didn't want to see it. They thought they could manage it. They were wrong. And now we're doing it again. Let me show you how. In 2020 and 2021, the Federal Reserve dropped interest rates to near zero to fight the COVID recession. Money was free. Commercial real estate owners borrowed massively. Office buildings, apartment complexes, shopping centers. Loans at 3-4% interest rates, 5-year terms, 10-year terms. The assumption was that office occupancy would return to normal, that workers would come back, that rents would keep rising, that property values would stay high. None of that happened. Hybrid work became permanent. 72% of companies adopted remote or hybrid strategies. Office demand collapsed. And it's not coming back. Workers don't want to commute 5 days a week. Companies realize they don't need as much space. Leases expired, and tenants either didn't renew or renewed for half the square footage. Vacancy rates started climbing. First 10%, then 15%, now over 20%. And it's not evenly distributed. Class A buildings, trophy properties in prime locations with high-end amenities, those are mostly full. Tenants are consolidating into the best buildings. But Class B and Class C properties, older buildings, buildings in secondary locations, those are empty and getting emptier. Meanwhile, property values fell. If nobody wants to lease your building, it's not worth what it was in 2021. Appraisals dropped 10, 20, 30%, but the loans didn't drop. The debt stayed the same. Then in 2022, the Fed started raising rates from near zero to over 5% in 18 months. The fastest rate hiking cycle since Volcker. And just like the 1980s, borrowers who had loans maturing suddenly faced refinancing at much higher rates. A building that had a 3% mortgage in 2021 now needs to refinance at 6 or 7%. That doubles the interest payment. And because the building is worth less, the loan-to-value ratio is broken. Banks won't lend the same amount on a property that's lost 20% of its value. Owners need to come up with more equity. Most don't have it, so they try to extend the loan, renegotiate, ask for forbearance. And banks, not wanting to recognize the loss, often agree. Extend and pretend. Kick the problem down the road, restructure the loan, extend the maturity, and pretend it's fixed. It's not fixed. It's just delayed. And the delays are running out. Because in 2025, $950 billion in commercial real estate loans are maturing. That's hard maturities. Loans that must be repaid or refinanced. And most can't be refinanced. Not at current property values, not at current interest rates, not with current vacancy levels, which means defaults, massive defaults. And the banks holding those loans are about to take massive losses. Regional banks are the most exposed. According to the FDIC, many community and regional banks have commercial real estate loan portfolios that exceed their risk-based capital. That means if even a small percentage of those loans default, the bank is insolvent. And office loans are the most toxic. 19.6% vacancy means nearly 1 in 5 office buildings is sitting empty. Those loans are going bad first. 1211 Avenue of the Americas is just the beginning. A $1.04 billion default on a Midtown Manhattan office tower, built in 1973, 2 million square feet, and the owners walked away. If that's happening in Midtown Manhattan, what's happening in Phoenix? In Dallas? In Charlotte? Secondary markets where vacancy is even higher? The defaults are coming, and when they come, regional banks fail, just like the S&L. Here's the timeline. Through 2028, $2.3 trillion in commercial real estate debt matures. $600 billion annually, every year for the next 3 years. And the refinance environment isn't getting better. The Fed might cut rates slightly, but we're not going back to 3%. We're not going back to the free money era, which means the maturity wall is real. And the only question is how bad the losses are and who takes them. In the S&L crisis, taxpayers took the losses, $160 billion. In 2008, taxpayers bailed out the banks, $700 billion in TARP funds plus trillions in Fed support. This time, the structure is different. Most office loan risk is in commercial mortgage-backed securities, CMBS, not on big bank balance sheets. The investors who bought those securities, pension funds, insurance companies, foreign investors, they're taking the losses. But regional banks still hold massive exposure. And when they start failing, the FDIC steps in. Deposit insurance covers the depositors, but someone has to liquidate the assets. Just like the RTC in the 1990s, there will be a resolution mechanism, government-backed or government-run. And just like the 1990s, the assets will be sold at fire sale prices, 30 cents on the dollar, 50 cents on the dollar, whatever buyers will pay. And that's where the opportunity is. Because every crisis has winners. People who see the pattern, people who have cash when everyone else is desperate. In the S&L crisis, the RTC sold $394 billion in assets between 1989 and 1995. Opportunistic buyers made fortunes. Sam Zell built his empire buying distressed real estate from the RTC. Barry Sternlicht did the same. The Resolution Trust Corporation was essentially a clearinghouse for distressed assets. And buyers with cash and patience bought buildings and land for 30, 40, 50 cents on the dollar. They held through the recovery, and when the market came back, they made 10, 20, 30 times their money. The same thing happened in 2008. Let me show you the exact playbook. Blackstone. In 2007, Blackstone bought Hilton hotels for $26 billion, leveraged buyout at the peak of the market. Then the financial crisis hit. Hilton was drowning in debt. The company nearly failed. Blackstone could have lost everything. But they didn't panic. They restructured the debt. They worked with lenders. They waited. And in 2013, they took Hilton public, made a $14 billion profit, one of the most successful private equity deals in history. But that's not all Blackstone did. Starting in 2012, Blackstone began buying foreclosed homes, single-family homes that had been repossessed by banks during the housing crisis. They created a company called Invitation Homes and bought 48,000 houses between 2012 and 2016, paid an average of 60 to 70 cents on the dollar. Then they rented them out, bundled the rental income into securities. And in 2017, they took Invitation Homes public, made $7 billion. $7 billion buying houses nobody else wanted at the bottom of the market. Brookfield did the same thing in commercial real estate. In 2010, Brookfield bought General Growth Properties, the second largest mall owner in the United States, out of bankruptcy, paid $2.6 billion, restructured the company, held it through the recovery. By 2018, the portfolio was worth $9 billion. Brookfield also became the second largest office owner in the United States by buying distressed office properties after 2008, buildings that banks were desperate to unload, buildings that were underwater on their loans. Brookfield bought them at discounts, 40, 50, 60% off peak values, held them, leased them up, and sold them years later at massive profits. This is the pattern. Cash plus patience equals generational wealth. When everyone else is forced to sell, the buyers with liquidity make fortunes. And it's about to happen again. $950 billion in loans are maturing this year. Owners who can't refinance will be forced to sell. Banks that can't extend the loans will foreclose. CMBS investors will take losses and liquidate properties. And buyers with cash will step in, just like Blackstone, just like Brookfield, just like the RTC buyers in the 1990s. The distressed sales are already starting. Office buildings in secondary markets are trading at 50, 60 cents on the dollar. In some cases, less. And the wave is just beginning. By 2026 and 2027, when the maturity wall really hits, trophy properties in major markets will be available at discounts. The same buildings that were untouchable in 2021 will be for sale at 30 to 40% off. And whoever has cash at that moment will acquire assets that will compound for decades. But there's a flip side. If you're on the wrong side of this, you get wiped out. Just like in the S&L crisis. Just like in 2008, over-leveraged property owners lose everything. Regional bank stocks collapse. CMBS investors take massive losses. The people who trusted that the system would save them, that extend and pretend would last forever, that property values would come back, they learn the hard way. The math doesn't care about hope. The math cares about cash flow and debt service. And when buildings sit empty and loans can't be refinanced, the math says default. So what does history say about protection? First, avoid the obvious risks. Don't own over-leveraged commercial real estate. Don't own regional bank stocks with concentrated CRE exposure. Don't hold CMBS securities backed by office buildings. Those are the assets that will get destroyed. Second, hold liquidity, cash, treasuries, assets that preserve capital and give you dry powder. Because the opportunity isn't now. The opportunity is 2026, 2027, when forced sellers are liquidating and prices hit bottom. Third, be patient. Blackstone didn't buy Hilton in 2007 and flip it in 2008. They held it for 6 years. Brookfield didn't buy malls in 2010 and sell in 2011. They held through the recovery. The fortunes are made by people who can afford to wait, who don't need the money today, who can hold through the chaos and sell into the recovery. And fourth, understand that this is a transfer. Wealth doesn't disappear in a crisis. It moves from the leveraged to the unleveraged, from the desperate to the patient, from the many to the few. 3 times in the last 40 years, commercial real estate has triggered systemic crises. The S&L crisis in the 1980s, the financial crisis in 2008, and now, in 2025, the maturity wall. Each time, the math said it was coming. Interest rate shocks, overbuilding, excessive leverage, deregulation or complacency. The ingredients are always the same, and each time, the people in charge said it couldn't happen. The S&L regulators in 1985 said the industry would recover. It didn't. 1,043 institutions failed. The bankers in 2007 said real estate always goes up. It didn't. The global financial system nearly collapsed. And now, in 2025, office building owners and regional bankers are saying the same thing. Vacancy will come down. Rates will fall. The Fed will save us. They're wrong. The math says they're wrong. $950 billion in loans are maturing this year. Property values are down 18%. Office vacancy is at 20.7%. Delinquencies are higher than 2008. And the refinancing wall is real. The loans can't be rolled over. The buildings can't be sold at par. The losses are coming. And when they come, regional banks fail. Just like the S&Ls. Just like 2008. Except this time, the bailout is harder to justify. Because this time, everyone saw it coming. The office vacancy data is public. The delinquency rates are public. The maturity schedule is public. The math has been screaming for 2 years. And the people who ignored it will pay the price. But the people who listened, who held cash, who waited for the distressed sales, they'll make fortunes. Just like the RTC buyers, just like Blackstone, just like Brookfield. Because the pattern never changes. Crisis transfers wealth from the unprepared to the prepared, from the leveraged to the liquid, from the hopeful to the realistic. The S&L crisis cost taxpayers $160 billion and made a handful of buyers generational fortunes. 2008 cost taxpayers trillions and created Blackstone's real estate empire. In 2025, with $950 billion coming due and no way to refinance it, the pattern says it's happening again. The math is locked in. The only question is which side you're on.